Hey, welcome back to Two Super Guys Trade Stocks. I'm Dylan.
And I'm Vinny. And today we're going to talk about Target stock. It's dropped a lot post-pandemic here. Dylan's been kind of asking me about it. I constantly get stuck into going in here with my wife because she goes in there for two things and comes out $300 later. So I wanted to figure out, is that a good investment opportunity? So we're going to take a peek at their financials, see if it makes sense.
Two Stupid Guys Trade Stocks.
So I think this is quite attractive at the price. I have done zero research. I have bought 20 shares.
Okay.
Just
Fair enough.
just pure the price being at pre-COVID levels is pretty wild to me.
Yeah.
So
I get it. Did you happen to peek this? So this is a 5-year chart. It's up 40% over 5 years. That's
Yeah.
actually not very impressive for a
It's not
company
great.
that is like a household name.
I
I
agree.
looked it up on a couple of lists, and as far as like brand value, and I want to say they were like number 65 or 50, somewhere in that ballpark. They're one of the more recognizable brands in the world. Yet financially, like they're not as all cracked up to be. So they had the massive COVID surge here, and then they've kind of come back down in the meantime. Now, that is indeed in part, macroeconomic, but they're having some own issues. One thing that caught me by surprise here is when I looked at this little CNBC fact sheet here. Market cap only 57 billion. I didn't realize that they were actually that small in comparison. $57 billion market cap.
I'm
Believe
gonna
that?
look up Walmart. I don't remember.
Yeah, probably 200 billion. But PE's hanging out in the mid-teens here. Okay, so like that's
Oh,
in the range where like could be a little more
440
attractive.
billion.
Yeah. Okay, that makes sense. They did have this massive kind of surge up here in revenue, but they now had declined for the last year. They're down. Like if you want to slide yourself over here, you see the little red bar there. The
Oh,
revenue's been
okay.
declining, right? And then they most recently in their kind of last quarterly earnings, they talked about how they've also had a big consumer shift. We've talked about this in other aspects, but people are buying less discretionary items, which are higher profit margin items. They're buying more groceries and those sort of items that are necessary for daily living. So they're losing on the top line as far as revenue growth, and they're having some margin contraction because people are choosing to buy things that are a little bit less profitable, right? We're seeing the kind of gross margin collapse here, right? So they were hovering around 30% for gross margin. Now we're down to like the mid 20s.
It's coming
That's almost
back.
like sure, the little scoop up here. I
Yeah.
could show you a chart like that with Intel though, where their gross margin started to come back up.
Okay.
Would you buy
Fair
that?
enough.
And PE ratio for the longest time they were hovering around a 10 PE ratio. So they've come, kind of got a little astronomically out of hand there, and they've come back towards it, but they're still well elevated from their pre-pandemic baseline PE ratio.
Don't
Yeah,
like that. Okay.
yeah. And then price to free cash flow, right? Same thing. They were hovering around a 10 price to free cash flow, multiple here. They got a little wonky during the whole pandemic. Current price to free cash flow based upon this chart here was about 35. Yeah.
Okay.
I'm going to do the free cash flow yield calculation for you here in a second. So this is the cash flow statement from the most recent quarterly earnings. They ultimately had about $3.4 billion in cash provided by operating activities, right? Then what you do to figure out how much of that cash go to equity holders, you have to subtract off this expenditures of property, plant, and equipment. Now, to do this properly, I should go back and look at multiple quarters to make sure that they didn't have one quarter where they spent a whole bunch more on maintenance of their business. Because this is basically how much money you have to put back in the business every quarter in order to continue to generate that revenue, right?
Right.
This is just not necessarily upgrading, but continuing to recycle products and reinvest in themselves
Right.
at the pace at which things go bad, right? So they had to shell out $2.8 billion for purchase of property, plant, and equipment. And they had 3.4 come in. So that right there, you're talking about a difference, what, 600 billion, somewhere in that ballpark? I think it's 591 million, if I remember correctly, exactly.
Yeah. Okay.
What are they doing with that money? They paid almost $1 billion in dividends last quarter. Right, so they're a dividend company. You can go back and look at the previous chart. I forget what the yield was, but it does pay a reasonable dividend as far as if you're a dividend attractive person. I'm personally never a dividend attractive person. They do have authorized share repurchase program too. I think they said they had like $9.1 billion in share repurchases authorized. Look at this previous quarter here, 2.6 billion they had done there. They did none this quarter. The fact that they did none and the stock has come down significantly from where it was like last year, that to me is a warning sign that they're saying like even at this price, like we can't justify
Yeah.
buying back our own shares.
It's not
Which is
good.
scary.
Also, their dividend yield is 3.56%.
Okay, that's about what I thought it was. So this is me running through the math here, right? So 3.398 billion in cash flow, 2 billion in purpose of property, plant, and equipment. Jesus Christ, 577 million free cash flow at the end of the day. If I annualize that out, that's not a good proxy for them because they're a big retailer. Obviously, December they crush it comparatively when they're selling all the Christmas crap. That's 2.3 billion in free cash flow to equity holders per year on a $57 billion market cap. It's a 4% free cash flow yield. All right.
Yikes.
And also, I should mention that I forget exactly the number on the debt. It was like $12 billion in debt, despite having this, say 2.3. So the leverage ratio, if that was a true annualized number, would be like 5 to 6x, whereas 3x is kind of considered the cutoff before you start to get to a more risky leverage ratio for a whole corporation. So running through these like basic numbers, this is just a light look, but to me, this says Target. It's still not in my ballpark as far as reasonable valuations.
That's honestly kind of shocking because they were up towards, I can't remember, what was it, like 240?
Like 180,
240.
240. Yeah.
240 at one point. So almost double the price right now. And we're at about COVID. Are our wives but I just don't get it. They spend so much money at Target. Where's all the money going? Are our wives the only ones at Target? I've never
still a
stepped in
retailer.
Target. Is it just
Yeah,
it's just our wives and no one else?
just them. Just them. Yeah, exactly. And then the person at Starbucks too that sells the ridiculously good sugar cookies, but that's a different story.
What the hell?
I get the attraction from a brand perspective, but it's a retailer. This is like that Charlie Munger quote about
Yeah.
how at the end of the day, I realized it was just a retailer, and it's hard for Target to demand such substantial premium that they can be a much more profitable business for investors compared to Walmart. Walmart's got the scale, right? But they're worth 6x what on a corporation basis what Target is.
Yeah.
It's crazy.
This is kind of shocking. I should probably sell my shares. I only have 20.
Well,
but I mean,
it's something
at that
to
talk,
consider. Maybe do a little bit more homework on it. But yeah,
it,
I'm less interested at this point.
I thought 120 was attractive. To be clear, I also bought it for a swing trade because of the graph. I don't think it's going to be at 120 for a while. I feel like 90 is much more attractive, which just seems crazy low. But with the data you just gave, that would be about the drop that's needed. That's crazy.
Yeah. But I mean, in this territory, the 4% free cash flow yield, I can buy Google cheaper than that. Google has way better long-term characteristics, which is crazy to me. And Baba, don't even put me in that same contest. Baba is like 4 times cheaper.
Yeah. All right. All right, guys. Let us know what you think. And also if our wives are the only ones that are at Target, because I'm confused. So,
Yeah.
yeah.